You need to frame it first and
Yeah.
then go to the lessons. So
Yeah. So let me frame it first. I mean, I travel all around the world. I teach in different parts of the world. I'm absolutely fascinated with the differences I see in different parts of the world. And so whenever I have to go to a country for the first time, my first work is I can't just take my teaching notes from the US and take them to some other part of the world and just talk about Disney every part of the world. I love Disney as a company, but I can't use Disney as my example or Facebook as my example all over the world. I think that to do valuation, you got to relate to local examples, deal with local currencies, because that's how you make this real for people on the ground. So when I was invited to come to Uruguay, and I'm lazy, I usually don't start my work till about 6 weeks before my trip, saying, okay, let me go find a company. I did what I do in every other country I've gone to, whether it's Vietnam or Mongolia or Kazakhstan, all the countries that I've gone to. I go look for publicly traded companies in that countries to start my research going, because I know I can look at a company, I can look at how it does locally. And I look for a list of Uruguayan companies, and my list came back as null and void. I said, maybe I misspelled the name of the country, and I tried it again, no company showing up. And then I said, oh, maybe I'll go do Google search. Maybe my S&P Capital IQ database is not capturing Uruguayan companies. And I went and did a Google search, and Google said, I can't find any publicly traded companies either. So at this stage, I was a little puzzled, because this has never happened to me in a country where I've looked for companies and can't find any. So I had to kind of look outside the market, and I was reaching. And so that was my, so one of the first questions I had when I got here was, hey, what's going on? Where are your publicly traded companies? And I won't claim to be even close to conversant with Uruguay as it is, but here are my hypotheses for why Uruguay has kind of evolved the way it has. The first is it seems to be almost a culture of fixed income drives the way people invest. I don't know where it goes back to, but people want returns, but they don't want downside, which goes against everything in an equity culture, which is you got to be willing to lose money. So that struck me as the first potential reason is if you start to offer equity to investors, maybe they don't want to deal with the downsides of equity. The second is, I think Uruguay is in a strange spot because it's a small country between two very large and very volatile countries. And maybe your primary business historically is to be an intermediary or a transmission mechanism for the craziness of the two countries around you, which makes you more like the Cayman Islands than a traditional economy, because the Cayman Islands is not a big economy, but the way it works is money flows through the Cayman Islands because people trust the institutions of the Cayman Islands, especially if you're in parts of the world where you don't trust the institutions. So I think I have a better understanding now of why Uruguay does not have publicly traded companies than I did before. But I also believe that not having a marketplace of publicly traded companies is a problem. It's a problem that I think will get in the way of Uruguay developing and I mean, you're saying with 3 million people, how big can we get? I mean, let's face it, lots of companies fight well above their weight class. The fact that you have 3 million people doesn't mean you cannot be. Singapore is a small country. Think about the footprint that Singapore has globally, and it's vastly larger than its footprint. Because here's what Singapore did. It looked to see what its niche was. Its niche was everybody follows the rules, which makes it an exception in Asia where nobody follows the rules. It is also a country where things are efficiently done. So if you want to have a fight resolved in Asia, you don't want to fight that fight in Beijing or Kuala Lumpur or Mumbai, because it's going to be incredibly inefficient, probably corrupt, and you won't get the outcome that is the fair one. So what do? You go to Singapore. So I think if Uruguay wants to build its niche, and the way I see it is it could be the Singapore of Latin America. Let's face it, you have a lot of chaos around you and people are looking for steadiness. There is a place here for steadiness, but I think having a public market will make it an even better place, because the argument I heard was with 3 million people, our companies cannot get very big, but that's a circular logic, because the only reason your companies cannot get big is because they can't access capital. They can't access capital because they don't have public markets. And you don't have public markets because they are small. You will never get out of the cycle, right? There is no reason to break out of the cycle. So let me throw out a possibility. Could an Uruguayan company become a world-class global company? I don't see why not. I mean, where you're incorporated doesn't determine where you operate. I know companies in very small countries that have global, they reach pretty much every part of the world. But for that to happen, Uruguayan companies need access to far more capital than you get from banks lending you money. It has to be far more capital than mutual funds investing their excess funds. It has to be access to a capital market. And right now, those companies have to look elsewhere. They have to go to Canada, they have to go to the US. Those companies don't even exist, to be quite honest, because in a sense, you don't even have a mechanism. Because usually, the way companies end up, for instance, Embraer didn't end up in the US directly. It started in Brazil, and after about 10 or 12 years of establishing a base, it was able to go to the US. It was able to be a big publicly traded company with a $100 billion market cap. But it took that nurturing in the local market, because you got to learn your lessons in a domestic market before, because in the US market, you're thrown to the wolves right off the top. And if you're a company that is not used to that kind of scrutiny, you can wither on the vine because you've never seen that. So I think it's good to have a domestic market. Think of it almost like soccer. It's good to have a local soccer league where you build your stars before you send them off to Europe. If you send all your brightest 14-year-old soccer players off to Europe, most of them will not get to be soccer players. They'll probably end up in some other place. So that's the same way with companies. You need a domestic market where companies can nurture and build themselves up so they can become global companies. And to start out with the presumption that because you're a small country that is not possible strikes me as negative thinking. I don't see why it's not possible. And I think that I think that somebody's got to break this cycle. So I would hope to see some Uruguayan company, or maybe even one of the government-owned companies, enter the space and start this game. Somebody's got to be first for the cycle to be broken, but I think it needs to be broken.
Can you please get a little more specific on the consequences? Because you were very, very specific and very deep to the consequences of not having a trade market, or the benefits of, elaborate more on what you just said.
On the consequences of having a public market?
Maybe yes.
Yeah, first, there's obviously access to capital, right? The second is, it makes you accountable in ways that you don't have to be as a private business or a government-owned company. Accountable because every 3 months, you got to do full financials and tell the world that things didn't go well and that I think is healthy. I mean, I know people complain about how short-term markets are, but if you think about it, markets are magical places that they can take all this information on a Google or Facebook and come up with a price is mind-boggling to me. That millions of investors with different views can gather together. We underestimate how much information having a market price gives you. I'll give you an example. When I value a company, it's a private company without a market price. I am always going to have more trouble than valuing a company which has a market price. Partly because market prices often allow you to get inputs into valuation, like risk measures, but more importantly, once I'm done with my valuation of a company, guess what I check first to make sure that I haven't done something incredibly stupid? I check against the market price. So if my value is $10 and the market price is $1,000, I know some stocks get overvalued. I know that I probably screwed up somewhere. Maybe my number of shares is off. So having a market price is an incredibly useful input in valuation. Whereas when you value a private company and you're done, you say, am I right? Am I wrong? So the first thing is there's an incredible amount of fuzziness. But I think the accountability and the governance issues that come out of it are healthy for any economy. Because let's face it, some companies are badly managed and badly run. And if they don't have to be accountable, they will stay badly managed and badly run. There's no incentive to change. Markets, if nothing else, force you to think about what you're doing and whether you need to change. And I think that is a consequence that is healthy for companies. So in addition to the capital raising part, which people think about with capital markets, it's the governance and the accountability part that I think is going to be more critical. And that is what's going to allow you to think about separate the wheat from the chaff. The good companies and the bad companies is having a marketplace pass judgment on them.
And you also said something, if you can elaborate again, you said something like, if you don't open up public capital for companies to be large enough, they are either from the government or a foreigner will buy them. So maybe you can...
We all need exit strategies, right? So if you say I'm a family-owned business, that's nice. You're going to be a family-owned business, but even families start to break up and you have generational fights. At some point in time, even families want to get out of the business. If you have a public marketplace, there's a natural mechanism then for a family company to continue, because what you do is you list yourself publicly. The parts of the family that are no longer interested in running the business cash out by selling to public investors, and the family business survives as a traditional company. But if you're a family business and there is no public market and you want to exit, there's only one place to do it, right? You have to sell to somebody, and that somebody is going to be big and from outside your country, almost by definition. So your very best companies will end up being subsidiaries to the Coca-Colas, the Nestle's, the Newmonts of the world, simply because they have no other option. So if you're truly nationalistic, I think it is in your best interest to have a public marketplace in your country that allows your best companies to stay and become bigger. So this again is part of that self-fulfilling prophecy. When I ask you why aren't there any big Uruguayan companies, the answer might not be because you're only 3 million people. It's because the companies that could have become big Uruguayan companies sold out to Coca-Cola 15 years ago, or Nestle 8 years ago, and they never got a chance to get big. It's almost like having kids who you ship off to boarding school and never see again. So I think that building a marketplace, I think, is critical to keeping your best and your brightest here. And it goes beyond that. Without a marketplace with companies, there's an entire ecosystem that comes around public markets, right? Equity research, investment banks, portfolio management. So it's not just the companies, it's the marketplace. You have to think about the financial market environment you create. You're saying, how big can that be? New York City is an entire city built around the ecosystem of publicly traded stocks. There are very few New York-based companies that are actually on the New York Stock Exchange. But if you think about the ecosystem that comes from having a stock market, you have literally tens of thousands of people who live in that ecosystem. And some of those people are your best and your brightest people. Now my question in Uruguay is, what happens to your best and your brightest people who want to be in finance? You're probably losing them to trade in Tokyo or London or New York. And that's part of keeping your best and your brightest as well, is some of them would still go to New York to get the experience, but at least you have a market locally, they can come back and say, now I'm going to manage money, I'm going to run a portfolio. I'm a good mutual fund manager, I can do this in Uruguay. Now that person is not coming back because there are no mutual funds you can run which can invest in public companies. So I think it's not just that companies leave. Your best and your brightest young people might also leave because, not because they don't like the country, but because they want the opportunity of being an equity research analyst, a portfolio manager, an investment banker.
And also maybe how important do you think this problem is in light of the fact that we have a pension funds, the individual accounts and the capital markets will allow them for better.
I think it's part of the evolution, right? Because in a sense, if you're saving money and it goes into a pension fund, you want that pension fund to invest in the best places to get, deliver the highest returns. Now, I'm not saying the investments you have in Uruguay are bad, but they're restricted. Right now, you're investing in either bonds or quasi-equity, special purpose vehicles. And you're saying, okay, what's wrong with that? I'm getting a reasonable return. There's nothing wrong with it. But what if you had 3 other options in addition to those 2? I'm not taking away the options you already have, but I don't see how having more options can make you a worse pension fund than having fewer options. And right now you have fewer options. So I think that the advantage again of things being traded is it allows people who want to invest, who want to take the risk. And again, I would not force pension funds to invest in the public equities if that's what happens, because I think that is a choice you have to make given the risk tolerance of your investors. But it's good to have that choice because it spreads your bets. The essence of risk taking is you want to share risk with others. The risk sharing in Uruguay is very limited because that's what capital markets allow you to do. It allows you to share risks with others, right? So if you're a family company, right now every family has its entire wealth invested in the one company it owns. That is not a great or an efficient way to take risk. By giving you a choice of going public, I'm giving you a chance to share that risk and perhaps get a better trade-off on risk and return. And here's the other side, the final point, which is, I mean, I look at, now I'm close enough to Silicon Valley that I visited every 3 months and talked to a lot of founders and startups. Think about why a founder or startup in the US starts a business. They're excited about the business, they're filling a need, but ultimately it's greed, right? It is the expectation that if things go well, they can go public and become the next Facebook, the next Snap, the next Spotify. And that happens because you have a public marketplace out there. Many of them will not make it, but they're okay trying. Because the payoff, if you make it, is so large, they're willing to take huge risks to get there. It's like buying a lottery ticket, where the winning ticket wins 1.5 billion or whatever the most recent was. That's basically, and it essentially means you're going to see a lot more risk-taking and entrepreneurial activity in a market where there are more exit strategies. And right now in Uruguay, if you're a risk-taking entrepreneur and you start a business, my question is, what's your exit strategy? Where are you going to cash out? Especially if you're 23, 24, 25, and you want to cash out at 30 and move on, because there are a lot of entrepreneurs who don't want to run a business. They want to start businesses, build them up, and then let somebody else deal with the building up of the businesses. And right now, I know you don't have that exit strategy, which means you're not going to have a lot of startups. The excitement in economies always comes from new businesses. And if you don't have exit strategy, you're not going to get that many new businesses starting up.
So what do you think is the role of venture capitalists in an economy?
In fact, venture capitalists would not exist without public markets in the US. Right? Because in a sense, as a VC, your exit strategy is usually, if you look at a VC valuation of a company, it's usually a 3-year time horizon. At the end of 3 years, what happens? You put an exit multiple where you're going to take the company public. In fact, let's do an experiment. Let's suppose tomorrow I shut down the public markets in the US. Venture capital will die on the vine. Right? Because if I take away, because no venture capitalist wants to hold on to a company for 25 years. That's the definition of a failure. If I take away your biggest exit strategy, you're not going to invest venture capital. So this is that ripple effect. So if you say there are no venture capital, there are very few venture capitalists in Uruguay, why would I want to be a venture capitalist if I can't exit? So there are these ripple effects that come from not having public markets where that liquidity you get of being able to get, because that's what you lack, right? Because you don't have liquidity in the equity. It's not that you don't have equity. You have equity in your private businesses, but that equity is essentially illiquid. And having a liquidity option, the capacity, I'll tell you, for instance, in the US, one of the things that's increased the amount of entrepreneurial activity in the US is you now have a private share market where you can actually get rid of shares of private businesses. That's why when Facebook went public, people already knew what price was going to go public at, because they had 3 years of transactions, a private share market where owners could buy and sell shares. The liquidity that you create by having that is what allows you to take risks, because if you make a mistake, then you can get out. If you cannot get out, you're going to take far fewer risks. So there's this entire, the effects of not having a public marketplace spread far and wide past, hey, it's a source of capital. Because I've heard people say, well, if I don't need the capital, why would I need a public marketplace? We already have mutual funds with more money than they need. They can provide me all the capital I want. Why would I need a public marketplace? That's assuming that a public marketplace is there for one reason and one reason alone, which is supply capital. It's one of very many roles that a public market provides. And the other roles might actually be more important.
you were very clear on the benefits of having publicly so an equity market, and on the negative of not having it. It's a very tough question. How do we start developing it? What should be done? What should the
Somebody's got
do?
Somebody's got to break the ice. You can't do it collectively, right? In a sense, it's not like a societal or a government thing that's going to be done. It has to be a company that says, I know this is not done, but we're actually going to list on the exchange. Somebody's got to do this. So I would look around at your most successful family businesses. I would look at family businesses where the CEO is in his 70s, perhaps 80s, and has kids who don't really want to run the business, and he's looking to exit, and he's thinking about selling to a US company or a European company. And suggest to him that perhaps that he might want to be the first one to actually, and I would appeal to a sense of patriotic responsibility. Hey, it's riskier than selling it, but what's to lose? But somebody's got to break the ice. Either that, or if the government wants to do it, it's very simple. Take one of your government-owned companies and list it. Yeah. Make it a public company. And it's got to be a company where you have ambitions that go beyond Uruguay. Right? So because if it's your water company and all your customers, but if your power, I heard that the Uruguayan power company is actually one of the more innovative power companies around. They've replaced, they've got green energy investments. And if you're an innovative power company, why would you need to just be Uruguay based? Maybe you want to be the Latin American power company. In which case, you need a lot of capital, and your way of getting there is... So I would appeal to the most ambitious part of the government companies. Then maybe one of these companies should be listed. Again, somebody's got to break the ice. And if the government says, oh, no, that means we've got to sell shares to outsiders, you're still going to control the company. Let's face it, Vale and Petrobras have been privatized, but the government still runs the company. You're going to get your cake and eat it too, if you ask me. Because you're going to run these companies still, and you're going to be able to cash out. Your budget is going to look a lot better next year after you've privatized this business. So you get all of the benefits of running the business and controlling the business that you do now. But you also get this additional cashing out privilege, and you get the access to capital that you can use if you really are ambitious and you want your company to go beyond its borders.
And also, in terms of corporate governance, what kind of adjustments do firms do in terms of when transitioning to the capital market?
Well, to be quite honest with that government company privatized, my first instinct will be that nothing's going to change. The same board of directors is still going to be there next year. The same decision makers are going to be there. But you're right. If you raise capital from public markets, I think you have an obligation then to at least listen to public shareholders. You don't have to do what they ask you to do. In fact, you have the power to just say, go away. But I think you need to listen. And I think that's healthy. So when public shareholders say, you know what, why are you doing this acquisition? It doesn't seem to make sense. And they won't say it physically. They just say it by knocking down your market price when you announce an acquisition. That's public shareholders saying, don't do that acquisition. I tell managers, look, I know markets make mistakes. I'm not saying markets are right, but I never ignore what markets are doing. So when a market price for my company drops 15%, the market is sending me a message. It might be getting the wrong message, but I need to listen to that message and say, is there something here I should be incorporating into my decision making? So I think that's the change that's going to come about, is you're going to get some bearers. Right now what you have are the equivalent of the old royal courts. The king sits there and nobody brings bad news. Right? Because essentially, if you bring bad news, they chop off your head. So you have lots of people saying everything's great now, because that's the nature of completely controlled environments. Anybody who causes the environment to kind of go into chaos gets pushed out of the system. When you open yourself to public markets, things get a little more chaotic and uncontrolled. But we live in a chaotic and uncontrolled world, and perhaps it's best to listen to that feedback when you get it, because it might make you a better company.